My name is Fiso Wishambuto, and today I'll be taking you through some of the highlights from our Redefine Company Update Report. So on the summary side of things, we maintain our buy recommendation with an unchanged intrinsic value of 547 and an upside of about 21%. So since the last report, we actually haven't received any very stock-specific material information that has prompted us to change our view or our IV, and that's one of the reasons why it's remained the same. I mean, the next coming material information will be the interim results that are coming out next week on the 12th to give us a little bit more color on outlook for the rest of the year. And whether they're going to have any changes to their guidances for FY25. But with our maintained view, we still think that there should be further outperformance out of Redefine, primarily driven by continued yield level depression, catalyzed by interest rate cutting cycle, along with improving demand dynamics in the likes of retail and industrial. And even though we have highlighted that Redefine does have some risk because of its office exposure, we think that they could potentially be an uptick in the office side of things, given starting to see a lot of the companies pulling back on the work from home policies. And as we start to see a lot more people go back into the office, we're going to see the reversions coming up and the vacancies start to stabilize. So that's more of an uplift in the office side of the office sector overall, in sort of short to medium term. And we think Redefine might stand to benefit a little bit from that. But the primary focus is more around the yield level depression, retail and industrial. So the things that would change our minds, those things have not changed since the last report. And the first one is if we expect property fundamentals to deteriorate rather than improve across the retail, industrial and office, then we would start to be prompted to change our view and then consequently our IV as well. What we are primarily looking at is really just two things, vacancies and reversion. So the vacancies give us a very, very good idea on what proportion of the assets are actually being occupied. And then the reversions give us a very good idea on what the demand dynamics are starting to look like. So what we're starting to see in office now is a turnaround in the reversions, moving towards positive territory. So on average, they still remain a little bit negative, and that's because of the demand dynamics in the office space overall. But what we have been seeing in retail and industrial is really a pivot towards positive, with some property assets actually seeing positive reversions on the retail side and continuing to see positive reversions on the industrial side. So if any one of those fundamentals starts to give us signs that they are turning in the wrong direction, that would be one of the bigger points that would change our minds. The second one would actually just be an outlook change to government bond yields increasing and having a negative impact on property performance. So what we have seen in the last couple of weeks is a lot of volatility around the market overall and bonds, and it's primarily because of a scare of a possible global recession, and then on the South Africa specific side more on the GNU. But when we take that all into collective, look at the multiple levels at this point, we still think on a risk adjusted basis there is some potential upside to come out of Redefine, and that's why we still have that buy recommendation and the 21% upside from our IV.